Hi, Yaron. It's great to have you with us today, and thank you very much for your time. I really appreciate it. And good morning, New York, right?
Chicago, yes. Good morning, good afternoon to you, and thanks for having me on this.
Great, perfect. So maybe before we start, maybe you will shortly introduce yourself, your background, what you do for Jefferies, etc.
Sure. So again, my name is Yaron. I'm Jefferies North America Property and Casualty Insurance and Insurtech Analyst. Big, long title. I've been at Jefferies for about 2 years. I cover publicly traded P&C insurers, brokers, and the Insurtechs, the publicly traded Insurtechs as well. I've been on Wall Street for 16 years now, various roles in banks, covering life, P&C, Insurtech, last few years. And before that, I was at AIG as a directors and officers underwriter, or actually financial lines underwriter. So that's me in a quick nutshell.
Fantastic. So we know each other for many years now. I had a lot of discussion with you, even in your days in Goldman Sachs. And I think that you are one of the most knowledgeable people in our industry in terms of valuating companies, valuating Insurtech companies. You saw them all, and you've been following them all. And so I would like to start with the first question that drives these interviews, and this is about the valuations of the Insurtech industry. We have seen huge declines in valuations in the last 2 years, and very bad market sentiment about Insurtech companies. And I'd like to ask your opinion about it. Is this something that is temporary? Are we sobering, or this is going to be changed in the next year or two? What are your projections around this?
Yeah, that's a great question, one that I encounter regularly and spend a fair amount of time thinking about as well. And maybe to preface this, or to set the stage for this question, when I think about Insurtechs, I think I give it a very narrow definition. So you need to be a balance sheet company, namely an insurer, or distributor, or maybe some combo of the two, an MGA. But I do not look at like the Guidewires of the world,
right,
media alphas of the world, where clearly they service the insurance industry, but they're not, I would argue they're not actually engaged in the act of insurance. So in that subgroup that I do look at, you're right, we've seen a valuation collapse. I would argue that that stemmed from two things. One, when the first Insurtech came to the public market, Lemonade, followed in very short order by Mile, Root, and Hippo, it was a completely novel concept to a lot of investors. Maybe a little less so to insurance-oriented investors, but certainly to the broader public market was looking at growth opportunities. Insurance was new. And this idea of we'll be a capital light structure, and we'll be unprofitable at first, but we'll get to, the TAM is massive and we'll capture that TAM and disrupt the industry, I think resonated with investors who didn't necessarily understand the insurance aspect of it, the unit economics of insurance, the fact that maybe growth is not necessarily difficult to come by. It's profitable growth. That's the challenge in insurance. You can easily grow yourself to death. So I think with that, the valuations at first were, in my humble opinion, just nonsensical. And they were often driven by revenue multiples. And that too, I think, was nonsensical, because again, it doesn't capture the essence of the risk and of the insurance proposition, if you will. So I think right out of the gate, the bar was set too high, and unrealistically so. But the public market is a quick learner. And I think over the course of the following year and a half, you saw more and more investors ask more insurance oriented and relevant questions around unit economics. and realizing that, you know what, massive growth per se is not necessarily all that interesting if you can't also tie it to profitability. And then you brought in, along with that, a changing broader market dynamic where the SPAC craze ended.
Right.
The excitement beyond Insurtech about disruption and growth and TAM only also started to take the back seat to when are you going to become profitable? When are cash flows going to be positive? And once that dynamic shifted along with a better understanding of insurance, that led, in my view, to the collapse in valuations that we've seen the last year and a half or so, 2 years now. But we've fast forwarded now these 2 years. There is better understanding. There is more focus on unit economics, which is not lost on the management teams and the boards. And you asked me if there's something that could change the current trend. I'd say, first of all, we have seen some stabilization the last few months. I mean, I don't want to say that we've hit bottom, but we've certainly not seen the rate of deterioration or of derating that we've seen the first year and a half of their public existence. And I think the next stage would be to see the first of these companies turn profitable, turn cash flow break even or even positive. And with that, the first of these companies that will be able to answer that or show that, I think will start getting valuated maybe more in line with kind of traditional insurance valuation. So whether it's price to book, I guess some people look at price to earnings, but right now we don't really have earnings. Book value is a fleeting number that really changes by the day with the cash burn that you have. So those traditional metrics don't quite work today. And I think once you're able to apply more traditional valuation frameworks to these companies, and they start acting like maybe a bit more mature companies with positive cash flows and with a positive earnings stream, that to me will be the next step in the evolution, and we'll start seeing maybe an upwards re-rating for a change.
Absolutely, yes, very interesting. Do you think that the market punishes the Insurtechs in terms of multiples, etc., after they really saw a huge values before a year or two? Is this like a punishment process? Is this something that is coming from the incumbent side? Is this just a sobering of the whole ecosystem? What do you think about it?
I would probably use the word sobering over punishment. Punishment to me has a vindictive, deliberate decision of, you hurt my investment portfolio, I'm now going to make sure that you go bankrupt. Like, I don't think that's how the market works. But there has been a sobering, absolutely, in the industry or among investors. And you've seen a lot of the tech-oriented investors or growth investors who said, you know what, this is not a SaaS model.
Right.
I don't understand it, or I don't want to be in balance sheet businesses. And you can tell me you're capital light till you're blue in the face, but ultimately there is a capital component to it. We can debate how light it is. And I'm not interested. And then you have insurance-oriented investors who say, look, call me in a year, call me in 2 years, call me in 3 years when you have a profitable business and a stable balance sheet, and we'll talk. Right now, I have nothing to do here. And, once you start measuring, or if you even attempt to measure these companies by more traditional valuation metrics that are applied to other insurers, these still seem expensive, right? Because they don't have a profit today. So I think for those reasons, the sobering is still ongoing. Also, let's face it, there's large short interest in each of these names, which also makes investing a bit more challenging. The float is not great, so getting in out of these names is challenging. So I think you need to find a core set of investors who'd be interested in this. Probably more realistic to look for them in the insurance, among insurance investors and not among growth and tech investors. Once you find that core set of investors who will be your anchors, maybe you also are able to then grow into a larger valuation, more float, more volume, more trading volume, and a smaller short interest, and then you get a resolution, or kind of you move past this phase of their existence in the public markets.
So if I may guess, based on what you've said, I think in 2 years from now, we're going to start seeing the companies that did succeed to make it to profitability, or having working business models. And then we might see some interesting things going back to the market.
I think so. And I would even take it one step or two steps further. One, I would argue that you kind of have to be in that stage within 2 years, because you're going to run out of cash otherwise. So by hook and by crook, you're either going to be profitable or break even, or you're out.
Or you're dead.
You're dead. Maybe you sell. You get acquired. Something like that. But I do think that timeline is roughly 2 years, give and take a little bit.
Right.
And obviously, you can control for it a little bit by accelerating growth, decelerating growth. Something that we probably want to talk about later on as well. But then on top of that, there's a whole other set of Insurtechs waiting in the private markets that, some of them we've seen headlines around them looking to go public and shelving those attempts and initiatives. Some didn't say anything, but we know are looking to go public at some point. And I think they've also looked at this playbook and the reaction of the public markets and realized, you know what, I can't go to market today because I still don't have that profitability. I am better off waiting another 2 years, another 3 years, and then going public in 2025, 2026 with a real earnings base off of which I can be valued. So I think it's not just the 3 companies that we're looking at today in the public markets. We could also see additional companies that have cleared kind of those first few years of unprofitability in the private, where you should be doing that, and then going public on the verge of profitability or already profitable.
Yeah, I agree. Completely agree. One more quick question, Yaron. Thank you very much. This is great. A quick question, because you are there all across the market. What can you tell me about the major trends that you see for the upcoming years?
In the overall P&C market?
Yes, in the overall P&C market.
Yeah, so look, if we start from where we are today, so we're entering a hard reinsurance market in property.
Yes.
That's ultimately going to hit the primary market as well. They're going to try and pass some of these elevated costs back to their customers. They will also not be able to purchase as much protection for low kind of 1 in 3, 1 in 5 year events, 1 in 2 year events. Those will be borne by the primary market going forward, for at least for the foreseeable future. And I think that forces them to be more selective on risk and more thoughtful on geographic footprint. So we could see some changes there, and we've already started to see that, right? Even before the hardening reinsurance market, with primary carriers pulling out of the coasts or moving away from the admitted market into the E&S market on the coasts. I'd expect that to continue. The second trend that I'd be looking at is maybe rate versus loss trend dynamics in the primary commercial market. I think right now one can make an argument that rate and trend are roughly aligned. I think over most years, loss trend is worse than rates are. So you are seeing margin erosion, or the potential for margin erosion. That's not been the case the last 4 years, but I think that the property market that is clearly hardening, we may be heading in that direction in casualty.
Right.
And the property market, we'll see how long it lasts. I would think it lasts, and we'll see what storm season does this year and how much wildfires we have, and if there's an earthquake or not. But I think on the face of it, assuming that this is another $100+ billion cat year for the industry, this is probably going to be a 2 to maybe 3 year hard market in property reinsurance.
Wow.
And also we'll see what the ILS market does if it comes or not. Then finally, you have personal lines. So personal lines clearly are getting squeezed by the reinsurance market. Also, if you are in auto, you're seeing horrific loss trends that are stickier than you expected. So you need more rate. So I think that at least for the next 2 or 3 years, personal lines probably become more interesting because you have a hard market, rightfully so. You need a lot of rate. At some point, the loss trends subside. I don't know when, but we're not going to be in 10 to 15% loss trend range in personal auto forever. And that would suggest that somewhere over the next 2 to 4 years, you will probably over-earn. And that's a good thing. But we're not quite there yet. But so those are the things I'd be looking at. And then I think the context of where Insurtechs fit into all this is very interesting. The only Insurtechs we see in the public markets, obviously, are in the consumer space or personal. We haven't really seen much in commercial in the public markets. So from that perspective, I think the very tough loss trend environment we see in auto can present a real challenge to the Insurtechs on the one hand. On the other hand, this is your opportunity to put your money or where your mouth is and show that you actually have this great advantage with telematics, with segmentation, with identifying the right customer. If you can't shine now, then I think the investment community will have to ask the question of, do you really have a competitive advantage?
I agree. I think this is exactly what's going to happen. Wow, Yaron, this was enlightening. Thank you very much for your time. I think it was a great discussion. Thank you so much.
I enjoyed it very much. Thanks for having me join us.
Thank you so much.